एवरीवन और आज की इस क्लास में आपका बहुत बहुत स्वागत है। आई एम मिस्टर संदीप कुमार, पीजीटी कॉमर्स फ्रॉम पीएम श्री केंद्रीय विद्यालय नंबर 2 गया। बच्चों, today we're tackling a topic that is absolutely guaranteed to show up in your board exams. We're talking about the crucial 8-mark question on accounting for share capital. Yes, oversubscription and that dreaded pro-rata allotment. But hey, don't worry at all. I'm going to break everything down in detail using both English and Hindi so the concepts sit right in your head. Let's get started.
Here's a quick look at our agenda for today's explainer. We'll cover the basics of oversubscription, the 3 alternatives, understanding pro-rata allotment, calculating those adjustments, mastering the journal entries, and finally, some key exam tips and a conclusion. All right, Section 1, the basics of oversubscription.
Bachcho, pay close attention here, because this is where we build our foundation. If your base is strong, those big journal entries will feel like an absolute breeze. Think about a simple real-world scenario. बच्चों, अगर मेरे पास सिर्फ 2 balls हैं और 4 बच्चे मांग रहे हैं, तो क्या होगा? If I only have 2 balls to give, but 4 of you are asking for them, demand clearly exceeds supply, right? I can't magically create 2 more balls out of thin air.
And honestly, that brilliantly illustrates our accounting definition. Oversubscription simply happens when a company receives applications for more shares than it actually offered to the public. You see this a lot with really good, well-managed companies. But the golden rule of the Companies Act is super strict. A company literally cannot allot more shares than it originally issued. Just like those balls, if you only have 2, you can only give out 2. Moving on to Section 2, the 3 alternatives.
So, what can the company directors actually do when they get swamped with extra applications? How do they solve it fairly? Well, they've basically got 3 parts. First, they can just reject the excess applications and refund the money. जिनको शेयर नहीं मिले, उनके पैसे सीधा वापस कर दो. Second is a pro-rata allotment, meaning a proportionate allocation among everyone who applied. And third, which is what your examiners absolutely love, a combination. They reject some completely and apply pro-rata to the rest.
Section 3, understanding pro-rata allotment. Bachon, this is where the real accounting magic happens. And honestly, where most students tend to panic. But not you. What is this pro-rata magic? Imagine a company gets applications for M shares, but only has N shares to give. They create a ratio, like 5:4. This means for every 5 shares an investor applied for, they only get 4 shares allotted. Now here's the kicker. The applicant paid for 5 shares, right? But the company does not refund the money for that 1 excess share. Instead, they retain that extra application money and adjust it towards future allotment dues. पूरा पैसा वापस नहीं होता बच्चों, आगे adjust होता है.
Section 4, calculating pro-rata adjustments.
Okay, so how do we calculate this if a shareholder defaults? Let's look at the formulas you need to memorize for the exam. But wait, I have a super simple trick for you. I call it the Monge versus Mile trick. Monge means applied, and Mile means allotted. If a question tells you how many shares were allotted to a defaulter, kitne usko mile, you need to find out how many he applied for, kitne usne mange. You just take the total mange in that category, divide it by the total mile, and multiply by the defaulter's allotted shares. And if you know what he applied for, just flip the formula. Total mile divided by total mange times his applied shares. This trick is a real game changer for those tricky 6-mark questions. Section 5, mastering the journal entries.
Take a deep breath. We've reached the climax of today's class, the heavy lifting. This is where we map all those concepts straight into our journal entries. Let's set up a practical scenario. A company issues 10,000 shares at a face value of 100 rupees. It's payable as 30 on application, 50 on allotment, and 20 on the final call. But applications roll in for 12,000 shares. The directors decide to do this. 5,000 applicants get the full 5,000 shares. 6,000 applicants are allotted 5,000 shares on a pro-rata basis. And 1,000 applicants simply rejected. Lock this setup into your memory as we open the ledger.
Our very first entry is just receiving the cash. The public applied for 12,000 shares, and every single one of them paid that 30 rupee application fee. So bank account is debited, and share application account is credited by 360,000 rupees. Everyone happily gave their money up front, hoping to score some shares. Now, let's pause for a second. Think about it, Bacho. We've got 360,000 rupees sitting right there in the application account, but we only issued 10,000 shares. So where does all this cash actually go? We've got to split it. some to capital, some as an adjustment for allotment, and some as refunds. Let's unpack that massive transfer entry.
Let's be very patient and break this down line by line. First, we debit the share application account by the full 360,000 rupees to close it out entirely. Now, where does it go? First stop, share capital. But remember this golden rule. Share capital mein hamisha sirf face value jati hai for the actual shares issued. So, 10,000 actual shares times 30 rupees is 300,000 rupees. Next, what about our pro-rata folks? They applied for 6,000 but got 5,000. That's 1,000 shares of excess money. We don't return it. Instead, we transfer 1,000 times 30, which is 30,000 rupees straight into the share allotment account. Finally, those 1,000 applicants we flat out rejected, unke paise unhe wapas de do. We credit the bank account by 30,000 rupees to refund them. Simple, right? Moving on, we're about to ask everyone for their allotment money. And here is a massive rule for pro rata. You cannot ask a shareholder for money they've already given you. So, the actual cash you receive on allotment is going to be the total allotment due minus that excess application money you just adjusted a moment ago. This next bit perfectly illustrates that impact. For entry 3, we make the allotment due for our 10,000 shares at 50 rupees each. Share allotment debit to share capital for 500,000. We're formally demanding 5 lakhs. But in entry 4, when the bank actually receives the cash, look at that figure. It's only 470,000. Why? Because that 30,000 rupees of excess money from our pro-rata applicants was already sitting right there in the allotment account from our earlier adjustment. We just deduct that and collect the net balance. Now, as you practice more advanced problems, you'll see times when people just don't pay this net allotment amount. When a call is due but not paid, it becomes calls in arrears. That's treated as a receivable asset, and we deduct it from subscribed capital. Plus, the company can charge 10% interest on it as per Table F of the Companies Act. On the flip side, if a shareholder is super proactive and pays future calls early during the allotment stage, that becomes calls in advance. That's actually a liability for the company until the call is formally due, and the company has to pay 12% interest on it. Make sure you keep these definitions crystal clear. Section 6. Exam Tips and Conclusion. You've done incredible work staying with me through those entries, Bachchan. We are in the final stretch, and I want to hand you a secret weapon for your board exams. Please burn this quick tip from your NCERT notes into your brain. It's the ultimate arithmetic test. Once you finish all your journal entries, application, allotment, calls, the whole shebang, just total up every single credit you made to the share capital account. That total must equal the actual number of shares allotted multiplied by the face value. So in our example, 10,000 shares times 100 rupees is exactly 10 lakh rupees. But John, if your trial balance doesn't hit that exact figure, you need to recheck your math immediately before handing in that paper. And before we wrap up, I want to leave you with a provocative thought. We just learned how pro-rata handles excess money, but what if a pro-rata shareholder whose shares were issued at a premium defaults and we have to forfeit their shares? Does the securities premium get reversed or not depending on what they've already paid? Ponder over that, because that is the exact 6-mark integration question examiners love to throw at you. You'll definitely need to study forfeiture and premium reversal rules carefully in our next class. Keep practicing those journal entries, remember your Manjar versus Mile trick, and you are going to ace this exam. Thank you so much for joining today's explainer, and happy studying.